Welcome everyone. This is a stock analysis for Alphabet, also known as Google. What a surprise. I'm going to do a quick valuation analysis where I'm going to show you why I think Google is the cheapest in the Max 7, particularly on almost every valuation ratio. Also, I think Google is the safest when it comes to tariffs, mainly because what Google does is considered as a service and they don't sell goods, which is great from a tariff perspective. That said, there are risks, not in regards to the Pixel, not anymore, after Trump has changed his mind once more last Friday, and he exempted smartphones from the 145% tariff on imports from China. But I think the biggest risk comes from the EU, where if Trump doesn't reach an agreement with von der Leyen, well, I believe she will implement tariffs on services, and that will impact both Google and Meta. And I think the chance for this is relatively high. I don't think this is a small risk that you should overlook. I think this is a big risk, but not in the next 90 days. So I believe this is a risk very close to the 90-day pause limit, where if they don't reach a deal and then Trump after 90 days, he says, do you know what, we're going to keep the 20% tariffs on the EU. Then I believe the EU will implement tariffs on pretty much Google ads and Meta ads. You know, they have been relatively safe when it comes to not paying tax in the EU or not paying as much tax in the EU on these services. And I think that the EU is going to target them. There are also stuff I'm going to discuss in the video, CapEx revisions, which, reaffirms from the CEO. We have an analysis when it comes to the cloud platform of both Microsoft and Amazon. We're going to see what they do, how well they are generating revenues. And we're going to see whether, ChatGPT is going to erase Google search revenue. Is that really going to happen or not? These are the things that I'm going to discuss in the video. It's going to be a long video. Don't expect to see anything short. So let's go into it. So let's start with a quick valuation analysis. On a price to earning basis, Google is the cheapest in the Max 7, period. There is no doubt on that. Usually, Google and Meta have been competing for the cheapest stock in the Max 7. And you can see Meta now is trading at 23 times earnings, which is the second cheapest in the group. And that's quite attractive, to be honest, especially if you think that there's going to be further downside ahead. I think that PE ratio that is reasonable or close to that of S&P 500s, I think that is, at least to me, it is something reassuring. If I see a P ratio of 123, that's not really what I want to see when the markets are selling off. In any case, sorry, I have a cold, so it's going to be hell for me to do this video. Right, P ratio, Google is cheap, zero doubts. On a price to sales basis, Google is the second cheapest, which makes sense because Amazon is pulling 640 billion in revenues in the last year. Google is pulling about 340 billion, so that's why it's the second cheapest. Of course, Amazon, they have their online retail platform, and selling stuff like physical stuff is not as profitable as selling digital stuff, and that's why PE for Amazon is 33 and not 20 like Google. I prefer earnings than sales. And just a quick note, because you're probably laughing at me right now doing a PE analysis, looking at PE ratios. Well, what's PE? PE, it's relevant only for mega caps. Yeah. Why? Because usually these guys, they don't game earnings, or they don't do it as much as the companies in what I call the I'm not going to use the name, anything below 2 billion. Yeah, so anything with a market cap below 2 billion, I will never look at PE ratios. It doesn't matter what a company does, doesn't matter it's a utility company, doesn't matter it's a quantum computing, BS stock, doesn't matter. whatever trades below 2 billion in market cap, I never look at P ratios because they are so easy to manipulate. Extremely easy through subsidiaries in our countries where they offload costs. Yeah, I won't go into the details. But yeah, P ratios on penny stocks, nah. Okay, now let's move on to cash valuation analysis. So we have a distinction between operating and free cash flow. And the main reason is because CapEx. So you probably know that there are 4 hyperscale in the US, and those are Google, Meta, Microsoft, and Amazon. And you can see in this column the reason why they're called hyperscalers. You can see the CapEx. It's absolutely absurd when you compare it to the other stocks in the megas, in the Mag 7, sorry. And it's crazy to see these values for these companies. And of course, they are doubling down on that expansion in the data center. It's not a data center business, it's the cloud computing business, which needs data centers. So that's why you see these absurd values. By the way, 2025 values for CapEx, Google has about 75 billion, Meta is 60 to 65, Microsoft is 80 billion, and Amazon is 100 billion. So 100 billion, and so far none of these guys have revised downwards these projections, which is great news because I was actually quite concerned when I've seen the turmoil happening around Liberation Day, and I was quite bearish on these capex plans of the hyperscale stocks in the US because if the enterprises are not adopting AI, why are you building the infrastructure? And usually enterprises are very conservative when you are nearing a recession. So I was quite skeptic on the entire tech industry in the US up until pretty much April 9. That's when I realized, okay, so definitely this guy, you cannot take that guy for real. I don't know. I myself, I don't take it for I don't take his words as set on stone, so to say. In any case, this is good. The CEO reaffirmed the capex for this year on April 10, so that was Thursday. Great, this is good so far. There were some rumors from TD Cowen, saying that Microsoft has pulled back on some leases in the US with 2 private data center operators. And then they released another report quite recently saying that, the Microsoft firm had backed out of data center projects slated to use more than 2 gigawatts of electricity in the US and Europe over the past 6 months. So that's quite concerning up until, Microsoft replied to these rumors, and, they say that 80 billion capex is still in place. They are not going to revise it downwards. Great. So that's the biggest concern I had for the earnings session, is that in the earnings calls, they're going to be like, do you know what? Let's decrease capex spending. And why is that bad? It's bad because the entire AI narrative, it stays on 4 pillars, and these 4 pillars are these 4 hyperscalers. And if these pillars show cracks in their foundations, that's it. The whole thing goes down. So that's why I was worried, and I'm not worried anymore. Okay, so let's move on to the valuation analysis. Coming back to the cash valuation, so we have price to operating cash flow. Google and Meta are pretty much tied in the first place, and on a price to free cash flow basis is the same. So this is great news, to be honest. I think the 2 stocks are cheap, and well, it's not that I think, it's that I see that they are cheap. and yeah, the beta is another parameter to take into account, which tells you how volatile the stock is compared to the S&P 500. And you can see the values here, really interesting. You can see that both Google and Microsoft have a beta of 1, which means that they follow the S&P relatively in the same with the same volatility as the S&P. And then you have the largest one, which is Tesla, what a surprise, 2.6. In other words, if the S&P sells off 10%, on average, Tesla will sell off by 26%. Again, I don't trust averages because what we have seen is that Tesla sold off by, was it 50%? So in any case, right. I conclude the valuation analysis, and on a cash basis, Google and Meta are tied when it comes to being cheap. And then when we look at earnings, I have no doubts Google is the cheapest in the Max 7 group. Now, if we look at the chart showing price action over the past 5 days, what we have here is the performance compared to the S&P 500. So this horizontal line that you see on the screen, this one right there, that's the S&P 500. Anything above that, it means that the stock has outperformed the S&P. Yeah, and anything below, it has underperformed during this period of 5 days. So, of course, NVIDIA was up by 12% above the S&P in the past 5 days. And then at the other extreme, you have Apple, well, not a surprise. And then, of course, you have Tesla, which considering, I say not a surprise for Apple because of the smartphone business in China. And the same for Tesla. I mean, for Tesla, I already done a video on that, so I won't go into the details on why the stock has sold off so much. In any case, you can see that Google is pretty much in the group of the Max 7, and it's following the average. Let's call it like that. So it's pretty much, this chart is pretty much showing the one beta that the stock has. So you will never see a stock like Google being here in the same level of NVIDIA, or being here in the same level of Tesla or Apple when it comes to the current tariff drama that we have in the US. So yeah, something to consider here is that the stock is relatively less volatile than the peers, and it's pretty much aligned with Microsoft, Meta, and Amazon. Yeah, so those are the 4 stocks in the Max 7 that are relatively boring when it comes to volatility. Great. What I have here is a chart showing you showing you the top stocks by the 5-day average dollar volume. What does it mean? So you look at the past 5 days, yeah, and you look at every day in the past 5 days. So every day you have a certain number of shares that have been traded, and then you have the price at which each share was traded at. So for example, if I buy 10 shares at $10, the dollar volume is 100. Yeah, so 10 shares, $10, 100. I look at dollar volume because just volume itself is not very relevant. I do look at this as well in some cases, but usually I like dollar volume because, of course, if you have a penny stock trading at 1 cent, it's not the same buying a million shares in that penny stock than buying a million shares in NVIDIA, because the share price is different. So that's the reason why I look at dollar volume. Sadly enough, Google, it's a boring stock, I gotta say. That's why it's not volatile. So NVIDIA and Tesla are leading when it comes to the average dollar volume over the past 5 days. We have Apple, we have Meta, Amazon, Microsoft, and sadly enough, both Palantir and Broadcom. By the way, I own 60% of my portfolio. It's in Avgo, it's in Broadcom. So these 2 stocks, which are not part of the Max 7, are above Google when it comes to the past 5 days. So yeah, it's a boring stock. Don't expect to see, volatility or exciting things happening. Quick overview on what Google does. So I think everyone knows what they do. Everyone is already used to their products, their services. So we have Google Search. What a surprise! Is the main service that they have, which includes ads when you type on Google stuff like lawyers next to me, and then you have those options at the top of the page. Then we have YouTube ads, the annoying YouTube ads, of course, you know about them. And then we have Google Network, which are the ads that appear when you read articles, you know, those stupid ads in the middle of the article or at the sides, which have been following you for the past 3 months, you know. That's why I have an ad blocker. In any case, Google subscription platform and devices. If you go to this, this is by the way the 10K, the latest 10K. So this sub segment within Google services called Google subscriptions, platforms, and devices. It includes a wide range of things. It includes, of course, when you pay the YouTube subscription to get rid of the ads. That's why they insist on them so much. Google One, which actually I have a subscription with Google One. You know, I have a lot of pictures and I don't want to delete them. So I guess that they caught me on that one. Sorry. And then we have platforms, which includes payments from Google Play, and devices, which includes, of course, the sales of the Pixel family smartphone. So that's what this segment includes. You can see the revenue is quite small. I mean, 40 billion compared to 264 billion for the entire, you know, Google Ads or Google advertising, what they call it. Yeah. So relatively small. It's about 5 times, 6 times more than the main business of Google, which is selling ads. Then we have Google Cloud. So Google Cloud includes mainly two things, three, I would say. So the first one is the Google Cloud Platform. This is a cloud computing platform. Think about AWS, think about Microsoft's Azure. So, you know, if you're a developer and you want to make an app, you know, of course, the app needs, you know, to have some servers to run the different requests that your users are sending to the app or the website, in this case, or the web app. And of course, these companies, they offer those servers, but not based on the developer's basement. You know, they offer them via the cloud, and that was a huge business before the AI, and now, of course, the AI is taking over, and you know, training LLMs is what makes sense right now, and it's what's using most of the computing power in the data centers, rather than just storing, you know, boring information about people's, you know, when they search through different applications. So we have Google Cloud. As I said, we have the GCP platform, and then we have Google Workspace, which is similar. Think about Microsoft Suite, you know, the 365. Well, Google has the same, but online. And I have to say that in my day job, you know, we used to use Microsoft 365. It was shit because if two people had to edit a spreadsheet and Excel at the same time, it was quite fucked because you had to wait until the other person finishes and then you can save your Excel. And that's why, you know, the company I work for, they pivoted towards the workspace, which makes sense because you can have multiple people editing documents at the same time. And it's cheaper. And it's in the cloud, even better. So other bets, I'm quite dissatisfied, you know, with other bets. You know, I had to do a ChatGPT search to find them because the 10K didn't show any of these bets. And, you know, I wanted to know a little bit more about these ventures, which of course these are at the, I wouldn't say R&D. Some of them are in the R&D stage or they are in the early stage. They cannot be considered as a unique segment yet. And the ones that I want to highlight is Waymo and Wing. So Waymo is pretty much, the reason I want to highlight this is because they bring hype, because they are so futuristic. So Waymo, of course, is the autonomous taxi that is absolutely smoking Tesla's robotaxi. And we have this project Google Wing. I gotta say, I never heard about this. I don't know how big it is, but yeah, it can bring hype. So it's something to keep an eye on, just in case, you know, the FAA allows these things to fly over your house anytime soon. So that's the other bets segment. When you look at revenue, it's peanuts, 211 million. So That's why Waymo is taking more attention than what it should, because Waymo is not bringing enough revenue to justify the attention that the market is giving to. Right. Finally, hedging gains. So you probably know that most of revenue, 50% to be transparent. So 50% of revenue in the US is generated in the US, which means that the other half is generated abroad, and that's bad when the dollar is losing power to the other countries. And that's why they had some bets, for hedging these potential losses due to currency fluctuations. And they actually made money with that, 211 million, which, sorry, I have to clarify, other bets are making 1.65 billion. So that's how much they made in 2024, 1.65 billion, the other bet segment. Good. Let's focus now on something, on a risk that I thought it was bigger than actually than what it actually is. Is ChatGPT replacing Google search? I argue the answer is yes, but revenue is not taking a hit because of this. Let's have a look. So Google Network. What was Google Network? These are the stupid ads that you see on articles when you go online and you want to search for recipes for whatever. Yeah. And then you look at an article and then you have ads all over the place in that website. Well, the developer, the webmaster of that page is using AdSense to make some money, because that's why they write stuff. They don't do it because they want to. It's their way to make some money. So that Google AdSense has been struggling from an impressions perspective in the past year, where we have seen a decline of 11%. Yeah, so 11% down of impressions. That's bad, particularly when AI tools like, you have Gemini, you have Claude, you have ChatGPT, you have Llama. So I don't know you, but in my case, most of the times I research stuff, I use ChatGPT. People say, it's not reliable. Yeah, it's not reliable for certain things, but it's getting very reliable, or reliable enough for my day-to-day stuff. Like, for example, that the query that I did before, which is what are the other bets segment for Google. And this thing has been searching, a lot of sources, which is good, because I don't have to do it myself. So of course, if I don't have to do it myself, that means that the Google network is going to lose impressions, which is what has been going on. However, the cost per impression has increased. It's like, wait, what? Let me explain. What I think is happening is that Google is using AI to understand who to show the ads to. So if a person like myself, who is extremely cynical and never buys anything from any fucking ad, they're not going to waste advertising budget with somebody like me. They're going to waste it with somebody that is, sorry to say, a sucker to click on the ads and buy the stuff. So that's why the cost per impression has been getting more expensive, whilst we have seen a decline in impressions. So I don't think that this decrease is only because people have stopped, researching stuff on Google search and they are using ChatGPT. I think it's because the algorithms, they are getting a little bit better at targeting the people that are actually falling for these ads. So I think that's the reason why we have seen that. And so I think that's the main part for the 10K I wanted to discuss. When it comes to Gemini, I gotta say, I'm not very bullish on Gemini. It's a great tool. Deep research is interesting. I think they released the 2.5 Flash version of Gemini quite recently. However, when you look at the target, Google said at the beginning of the year they're targeting about 500 million users by the end of the year. ChatGPT has 400 million users a week. You can see the difference. I mean, come on, man. Yeah, I'm not very bullish, I gotta say, on Gemini, but yeah, it's something to consider in case they get better than ChatGPT. All right, so next topic. Well, I wanted to show you here the main reason I'm not concerned about that decline in impressions that we have seen before. So if you look at Google search and YouTube ads and Google network revenue, yeah, let's look at the change year over year. So have a look. Google search, this was my main concern, I will be honest. Google search has increased revenue by 13% in 2024. Despite all the AI boom that we have seen with the LLMs, revenue is up by 13%. Why? Simple, because most of the revenue that is generated in Google search comes from high paid terms, such as lawyers near me, or I don't know, chiropractors near me, or whatever. Those kind of terms are the ones that bring traffic. And usually, when you look for a lawyer or a doctor or a physician or whatever you call them, I'm sorry, I don't speak English very well. Fuck that. Chiropracticians, I think you call them, or however. When you look for these guys, you don't go to ChatGPT, you go to Google. And when you look for an iPhone or a Samsung or whatever, you're not searching that shit in ChatGPT. You're searching it on Google, and of course, the results you get are there because people paid for those things to be there at the top. That's why you see this. It's actually increasing, which is amazing. YouTube ads increasing as well. Great. And the network revenue is down. And as I say, maybe the reason it's down, particularly in 23 as well, you can see it's been up pretty much all the years. And then in 23 and 24, it has been decreasing. And I think it's because I used to have a startup, and when I had to decide whether to use Google Network, it was always exclude Google Network and partners, always in my campaign, because usually the clicks will be very poor and not really drive conversions, which is what I was there for. And I'm not really surprised. And I think the reason it's decreasing, the revenue, I believe it's because of AI. So people are not really using, search queries like how to make a pancake. Usually that is probably done in ChatGPT now, not in Google. So the dynamics are changing, but I think overall the ads revenue is quite solid. Great. Finally, here I wanted to highlight the operating performance per segment. Something very important, very important. So, as I said before, those bets, that I shown you before, yeah, so Waymo and this crazy thing, the drone thing, these things are not profitable. And you can see here, particularly, the loss, 4.4 billion operating loss last year. And I like the fact that Google is using that. Sorry, I'm just going to delete the percent change. So I like the fact that Google is as transparent with this, because you can see which segments are driving gains. And of course, the Google services, which includes, as I said before, all those ads and, at some extent, the platform and the devices, they're pulling 121 billion in revenue. So, yeah, the ads are still safe. The increase is quite, if you look at earnings, just have a look at the chart above in pink. I have these ones as well. In any case, my point was that, the increase is from 95 billion in 23 to 121 billion in 24. Is that a 20% increase or a 25% increase? It's crazy. Now, what I am actually satisfied, no, not very satisfied with, is the Google Cloud platform. So Google Cloud is pulling about 6 billion in net income in 2024. Now, if we look at Amazon's AWS, operating income is about 6 times to 7 times larger. That's crazy. So you can see the market share, there is a big gap between, Azure. Azure, I think it's about 49. Well, this is not just Azure, by the way, it's Azure and the entire cloud business of Microsoft. So operating income is about 50 billion, which is crazy. So yeah, so far the Google Cloud platform is not there yet when it comes to market share in cloud computing. In any case, yeah, moving on. So I have this news. So I don't know how much to go through because there is a lot of stuff I wanted to discuss, and this video will get very boring very soon if I go through all the news. So I'll go very quickly. As I said before, the capex was about 75 billion in 2020. Sorry, it was reaffirmed to 75 billion for 2025, which is great because this was above 30% higher, yeah, than what the analysts have initially expected when it was first announced, back in February. So this is showing that the AI narrative is still holding, and the tariffs are not leading to a slowdown in economy, which will lead to a slowdown in enterprises adopting AI, which will lead to these guys lowering their capex spend this year. As I said before as well, Microsoft hasn't lowered their capex spend, and in fact, Google it's actually closing deals with CoreWeave to rent NVIDIA servers. So you have, and this was by the way on April 2nd, on Liberation Day. This was declared on that day. So from a narrative perspective, I don't see any downsides, to the capex spend for these hyperscalers. And you have Microsoft acquiring twice as many NVIDIA AI chips as tech rivals, and this was from at the end of last year. So of course, Microsoft is the one that is purchasing most of these GPUs, and Google has their own. I think it's the TPU series. I think they just released the 7th generation, which is fine, but of course they still need NVIDIA's GPUs. So the TPUs are not really important. So when it comes to the 32 billion acquisition for Wiz, this was the largest in Google's history. And this was quite a smart move because Wiz is specializing in cybersecurity. And of course, when you have a ton of data from a ton of companies and enterprises and startups, you want to be safe. You want those servers to be fully secured. Now, what is key about Wiz is that Wiz is also providing cybersecurity services to Azure. So I think I had here the list. So it was, there you go, AWS, Azure, Oracle Cloud. So those are the three main competitors in the cloud segment. And now Google is owning, part of the cybersecurity services for these guys. So I think this was a very smart move because I think it's as important to scale up as to scale up in a safe way. So if you have a lot of gaps in your, in your system, and your system is vulnerable to cyber attacks, I think that can be a big issue. So the fact that Google bought Wiz is quite exciting because now they're pretty much owning the cybersecurity segment for these guys. So that's good. And finally, for Waymo, we have, in Austin, we have 20% of all Uber rides were made by Waymo in what was it, last week? So this was data, about March, in Austin. So essentially, we have a chart here that is showing the adoption of Waymo in the different cities. So that is based on the volume, so how many people are booking those rides. And you can see that for Austin, the acceleration in the adoption rate is significantly higher than in San Francisco, LA, or Phoenix. So you can see in black, Austin, it's ramping up significantly. So that's quite good when it comes to the competition with the robotaxi, with Tesla's robotaxi, because, well, I think Waymo is significantly better positioned. Usually in a market take-all effect, the first to take market share is the one that leads. And I think Waymo is the one that's going to lead the robotaxi business in the US. And in fact, they are actually on track to start mapping streets in Tokyo. So, they want to expand outside of the US before Tesla. So again, I believe Waymo is going to be the go-to robotaxi service. and the fact that it's owned by Google, well, that's amazing. Deployments this year include Washington, include San Francisco, Atlanta, and Miami. So something to consider there. Although, as I said, from an operating income perspective, this is not profitable yet, or not as profitable as Google Ads. So I wouldn't get too excited with the Waymo segment in the near term. And finally, as I said in the intro, we have the exemption on smartphones from the 145% tariffs on China imports. Great for Pixel, because part of those Pixels are made in China, some of them are made in Taiwan, and now we have India. Well, now it means last year. So Pixel 8s are made in India, have been made in India for about almost a year. So it's good because the company is diversifying the exposure away from China. And as I said, this is the biggest risk in my opinion. We have a EU retaliation threat where, the president of the EC Commission could impose taxes on digital services. And that's where Google and Meta could, take a hit, because they have been traditionally paying very low tax on services in the EU. And mainly because they have Ireland and they route the earnings through Ireland. And I think that was a way for them to pay less taxes than if they were to be based in the EU. So this could be a big risk to being bullish on Google. So something to consider there. And finally, they have this digital taxation topic in the EU since 2017, I think it was. Let me just look at the timeline. 2017. So in about 8 years, they haven't reached an agreement on how this taxation is going to look like in Europe. So is it going to happen now? Maybe there is slightly more incentives, but I'm really not sure that we're going to have a clear framework on digital taxation in the EU, which means that Google ads probably are going to be safe, probably. Well, so I think that wraps my analysis for Alphabet. Overall, I am bullish on the company. I don't own any shares, and I'm not planning to buy shares anytime soon. In fact, I'm planning to dump my shares on Amazon and Broadcom and go into a 5x leveraged ETF on the S&P 500. So more details of that move in the next video. And yeah, that's it. Thanks for watching.